Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, January 18th, 2016. It's about quarter after 6 Eastern Time as I'm doing this video, and I wanted to get this out tonight to try to give a game plan to what things might look like over the next week and possibly the coming weeks. Let me just start out by saying, in a nutshell, I've talked quite a bit about this support level and the positive divergence on the 60-minute. I am at this point leaning towards a meaningful bounce off where at or near where the market's closed on Friday. In other words, give or take, I could see another maybe percent or two downside, maybe one more washout move, but I could also see us gap up and run tomorrow. I don't think, we're not, futures haven't opened yet, so we'll see where things are at. But that is, in a nutshell, my view is that I do favor a bounce from this level. I think the risk to reward is skewed to the long side at this point because we've hit that downside critical target, the lows that were made back in August and again in October. Those double bottom lows as well. We're looking here at a 4-hour chart. You can see the support, really this upper line here. That's, call it roughly 99.50. There's numerous tags of support back there in the cues from that level. I've talked ad nauseum about this spike, this errant, if you will, candlestick, and really how those trades were only lasted shortly after the open. But this is where trading normalized back on August during that meltdown, and then we came back and back tested. So these red lines here is what I keep referring to as a critical support zone. All along, ever since we made that second test, I expected another move down. Now from here, again, I do favor a move up. However, it gets a little, it's not black and white. Although I would quantify the odds of a bounce from here. If I had to put a number on it, I would say as much as 75 to 80% the odds that we have a meaningful bounce from this level. But if we don't, and here's why it's not simple, the next key support I see on the cues, if this level, this is that critical support here, I have it as a green line on this daily chart. The next critical support is down around just below the 95 level, at least the way I have it on this chart. So I don't see a whole lot of support, a little bit here in between 97-ish. And of course, anything's possible. But if we do encounter or if this sort of meltdown type selling, this very impulsive selling that we have continues, and this week these levels don't hold, Friday's lows and maybe a little bit below that, there we could see a washout move, and that would take us down about another, good another 5% lower on the cues. And let's just look at the SPY right now. On the SPY, we're at nice support as well, and what I'll do going forward is drill down to the intraday charts. These are daily charts here, but this is where, and I do think over time this level will be visited. Call it 181, 182 on the SPY. We have numerous reactions around that level. There's a reaction. So again, it's not as simple as saying, okay, yes, I do have a long bias right now. I do think we'll bounce, but I can't rule out. And if I put about 75 to 80% probability that we get a meaningful bounce, and again, that would take us up to at least this level here. I haven't really marked my overhead targets just yet. I will follow up with those by tomorrow morning. But that then gives us about a 20 to 25% chance that we have this meltdown scenario. Translation is, if we don't get that bounce, if I'm wrong, I'm looking for a bounce now at this point to materialize, and I don't think it'll take long, maybe one other test of those lows if it is going to happen this week. Let's go back to a 60-minute chart here. Some of the reasons, as I've cited on the site, are the bullish divergences in place. Didn't have it all marked up here on the QQQs, but you can see we have positive divergence in place, and that is one thing that I look for during an impulsive downtrend, impulsive selling. I look for divergence in place, at least on the 60-minute chart, before positioning, covering shorts, and going, reversing to a net long position, looking for a bounce that'll last more than a few hours or a couple days. And so far, that's what we have. As far as bounce targets, well, I'll get to these in a minute. Let me just, again, one more time, jump back to the daily chart and say that I would put the odds pretty small, under 25%, maybe 20% at best. even a little lower than that, that we do take out these levels and get a quick flush down move. And then again, in the Qs, that could take us all the way down there to 94.50-ish, give or take. I'll have to, zero in on these levels. And once again, on the SPY, that could take us down there to, the 181, 182 level. So how to play that? If even though the upside favors, or the odds favor an upside move, at least in my opinion as of now, but it would be very costly to get aggressively long if we do continue to melt down and sell off to those levels. So the bottom line is, you don't engage these markets aggressively, at least not at this point. If you've been pressing the shorts hard all along and you want to stay short with a trailing stop, that's where the big gains are made. It's hard for a lot of people to stick with a big move and catch the bulk of a major trend, even if they position for it properly. So there's nothing wrong. However, as you get down to these key support levels that I've been talking, and that critical support on the 60-minute chart, these counter trend bounces, if we look at just the one that we had the other day, here's a 15-minute chart, can be pretty sharp. We had the QQQs, here was that downtrend line that was pointed out. And, we had a very sharp rally or reversal, and then we broke down another sharp rally. So at this point, the trading gets tough. It's tough to trail a tight stop with volatility being so high and the markets being so oversold. One other way to really put this into words, we had the trading range that I talked about for quite a bit. We had for the last few months, the last couple months of the year and heading in early into January, we had this trading range where the Qs and the SPY had a similar trading range. Stocks were trading, and we broke down here. Let me pull it up on the NDX. I think that chart's a little more clear. There we go. This is the NDX, so that's what the Qs track. This was down in this area here. Let's draw it out, or highlight it at least. This was your objective shorting area. If you weren't already short the Qs, even though we had TQQ on as an official short from way back here, not far off the highs, and the market just slogged around sideways. But if you wanted to add or initiate a short position, this is where the risk reward was about as attractive as you ever get. We had a trading range, well defined, a breakdown of that trading range. We even had a back test to offer another add-on or entry if you missed the gap down. Now, as with each tick of the market, each tick lower, in other words, if we go down, the risk reward diminishes as you approach this critical support zone that I have down here. The risk reward rapidly erodes, especially once we get to that critical support zone. So that's why, again, shorting anywhere down around here is very, it's contrary to trading. It doesn't offer a good risk reward profile. Had you shorted here, you would have got caught in that rip, probably scared out or shaken out or stopped out, depending on how tight you run your stops. We had another big rip there. And again, I do favor at this point a reversal from at or anywhere near the bottom of the support range. If we go back, this is a 60-minute chart. You can see how well it's defined. There's that candlestick. You see the bottom, that candlestick tail right there. And that's where trading normalized in the August meltdown in the NDX. Let's see if we go back 4 hours. I don't have a line drawn here, but let's put it there. We have what I'm looking at is back in late 2014, 2015, a shelf of very well-defined support. So there's support back then, and that's coincidentally or not, in my opinion, not, where the trading normalized during the August meltdown, and then again we found support there in October, and now we're at that support level again. Of course, I've made the case here, and we're going to get into the longer-term trend indicators, that right now I can tell you all my short-term trend indicators are bearish, my intermediate-term trend indicators are bearish, and I have a mixed bag on my longer-term, and I'm talking the weekly and monthly time frames. The monthly time frames have yet to definitively confirm that we are in a primary downtrend or bear market. So that gives reason for pause. We're only halfway through the month, a little more than halfway through January, so we still have a couple weeks to go. So anything can happen, even though some of those monthly trend indicators are currently showing a bearish or a sell signal. Nothing that happens between now and January 31st matters. It's how those those monthly candlesticks and the trend lines and moving averages close at the end of the month. Same goes for a weekly indicator. You have to wait till the end of the week, end of Friday close, to see how those go. So that's what we're at. That's the story here, guys. We have a nice support shelf. And I do talk about, the more times that a support level is tested or tapped on from above, it begins to weaken and chisel. So it won't surprise me to see a break of that. And again, I'm not trying to use double speak here or give some unclear analysis. I can see the possibility we may break through there because we've already found support on that level. And if we do, I just showed you the levels that I think we're going down to in the SPY and the NDX, and I think a relatively swift move. That's the good news. If you do position long here and you can give it some room, I don't see, I see some things slowing down the economy, and this has been an artificial recovery. Margin levels at all, historic or multi-year highs. So a lot of things that could lead to additional selling as the margin calls continue to persist. We have that forced margin selling on a lot of long positions. We could melt down, but this is just solid support levels. So if you can tolerate a drop of another 7-8% or so, possibly even more, maybe 9%, we could get that. But then I would strongly suspect a bounce, or the markets to find support down here on the NDX, and that's be about 3,800 to roughly 3,720-ish, somewhere in there. The S&P 500, it's not a cleaned up chart. We do have some support. It comes in before that. It's not as, I don't see as much downside on the S&P. I think the S&P is quite a bit sold out, especially with the energy stocks. And there's some heck of some support down around not even a little over 2.5% below current levels, around the 182 level. So again, if you want to go long here, you could do that with roughly a stop a little bit over 3% to the downside. You'd want to only do that if you were targeting a move up of more than 3%, because to risk a 3% loss to only make 3%, that's a 1-to-1 RR. So if you did this, there's a 2-to-1 RR. I think the odds of a bounce up to that level are pretty good. In fact, my first target, I would say 194.50. I think that's a nice target area on the SPY. Let's look at the 60-minute chart, see if I've marked anything up here. Well, here's the 60-minute charts of the SPY. Bullish divergence in place on the 60-minute frame. Here's a trend line, pretty well defined. Not great, but quite a few touches, and we had that looks like a false breakout here last week. Prices moved back down, so we have the divergent low while at critical support. And just to show you that support, I have to go back a little farther in time. Here's a 2-hour chart on the SPY, and you can see how well that support level is defined. Go back 4 hours, and I don't have that one marked up. Sorry about that. Here's that trading zone that we fell out of back in August, and that led to that meltdown. Similar story here. So again, the meat on the bone for the short trade was shorting up here, and then as you approach this level, the risk reward has now flipped, in my opinion, to favor the long side. So I think, let's say you're trading the SPY or any derivative thereof, I would look at, what is that, Friday's low right here, I think. Yeah, Friday's low of 185.52, a stop, let's say 0.75 to 0.5% or below that, I think would give you a relatively tight stop, and you could probably look for a bounce trade that is going up to at least the 190, the 194.50-ish area, and quite possibly a back test to this pattern here if things really hold up. Let's look at that on the Qs real quick. Let's take the Qs, again, solid. That's that critical support zone. There's the 2-hour chart. If we go over to a 60-minute time frame, I've added some levels here. I can color these. Let's just highlight these to make them bright blue. And you can see the value as I click on it here. This is 106.25. These would be my bounce targets right here. Let's see, that is 104. Call it 107.50, and then ultimately based on my view of the charts, I really doubt that we would get much above, but I could see the possibility of a back test. Let me color that, highlight that, shade that area. Okay, so we'll just put a red line around it. Okay, so here's the trading range, which we broke down from, and now let's throw some Fibonacci retracements, just kind of get an idea. There's the low, got to even that out with the high, and you can see how well these levels line up. Here's the 30 there on the left, 38.2. So the 38.2 fib is right around the top of these reactions, and that's why I had this trend line set it here, or I'm sorry, horizontal resistance slash bounce target at 106.25. That also lines up nice with the 38.2 fib. As always, if I was targeting that, and I probably and I will be, my stops, if I decide to book profits at that point, or even partial profits, I usually set them below. Now, what I'll probably do on this at this point, I'm still undecided, and I'll follow up with my thoughts. Maybe trail a stop up because I could easily see a continued move up to this 107.48. Call it 107.50 level. You have a nice gap there. You zoom in, several reactions right there from the top of that level on the blue line. And then you'll also note there's the 50% Fibonacci retracement. And then, again, coincidentally or not, look how beautiful the 61.8, which is typically the top or upper end of a bounce and of a counter trend bounce, counter trend move if we are heading lower. That lines up beautifully with the bottom of that trading range. The late 2015, early 2016 trading range. So just to draw it out, and again, my thoughts I'll follow up with my thoughts as the week progresses. That's the initial bounce target. As always, we could see a reaction there, but I really strongly favor, unless we get that meltdown scenario, again, unless last week's lows don't hold and we move much more, anything more than just maybe a brief shoot down, maybe a 2-3% move, and that could reverse real quick. I can see that, a little fake out, flush out move. But if we get a breakdown and we trade below those lows back in October, and we're trading normalized in August, if we trade below there, let's just say 2 or 3 60-minute candlesticks closing below there, we're probably going to keep going lower. So other than a brief fake out that would hopefully close back up within one 60-minute trading period or candlestick period, that's what I'm looking at. And I'm actually favoring, I'd like to see a gap up tomorrow. And that would be really my minimum target if these lows hold right there, and bare minimum around 106. And again, I could see the possibility, but at this point in time, I'm not even thinking of when to recycle back into shorts. But I can tell you this right now: if we got up to that point, anywhere near close to a back test of that zone, that trading range there, call it. I'd probably even start scaling in just below at this target level I have here at 107.50, and I think I would be scaling in to be aggressively short up by that level. I can't say that definitively right now because I have to look at where the charts are. What I'd like to see if and when we got up there, and that might take, if anybody wants time frames, that's always a harder thing. It's one thing to say where prices will go, but to say when they'll get there is even harder. But this would be time-wise, I could see a bounce. It would probably go to about this point, and I'm looking to the left. What is the date on there? Friday. That would be the end of the month. That's the January 29th right now, where I have the crosshairs. So that would look something like this. It wouldn't be straight up, but it might be very impulsive. Once the buyers step in and realize the bottom's in, we've just had a heck of a sell-off. Oops, wrong annotation there. I need the arrow tool. So something like that, and that would be my maximum bounce target. And if we get well within, back up in here, because that's a mountain of overhead resistance, that would be pretty bullish price action at that point. So if you were to scale in short from that, what did I say, 107.50 level up to 109.50, and again, this is my tentative plan right now. If and when we get there, I may have booked all my profits by here if we even get there at 106.25, we'll see. But if I were to scale in that range there, then I would have to logically set a stop somewhere probably not too far above this top of this gap right here. You see the bottom of that gap, that's 110.25. And that to me, again, is objective trading, because now you're shorting right under a key resistance level. Likewise, if you want to sit back right now and this level holds and we start bouncing and you want to start getting long around this level, that's not very objective. Right in the middle, this is no man's land, in between critical support and massive overhead or key resistance. So what I'm going to do is go long here. I've got a little bit of long exposure. I'm slightly net long, after closing everything out short the other day, I think on Thursday, and then taking the profits. And then I didn't do much on Friday, but I have a little bit of long exposure to head into next week. And if I get an objective entry, I'll probably add on tomorrow. Okay, I think I'll stop there. I was going to cover the trend indicators, go over those short, but as I said, it doesn't take a rocket scientist to figure that just about any short-term and most intermediate-term trend indicators would be on a sell signal, because we've been heading down. I mean, the market topped, you can see, way back in the S&P topped long before the Nasdaq did. The Nasdaq was the last of the holdouts, topping in November. So that's, we haven't really gone higher since then. Maybe by a couple pennies. I forget if that put in a higher high right there, but you can see basically a double top, and we've been moving down since. So that's what I'm looking at. So near term, looking for a bounce, putting the odds pretty good at about 75-80% that we are going to bounce and bounce substantially up to at least this 106-ish level, we'll call it right now at this point. And but if we don't, we are at key support. Remember, support is support until broken, and if we do break that, SPY has some key support a little earlier, but the Qs, and remember, the Qs are a higher beta index compared against the S&P 500, meaning they tend to rise more and fall more on any given day and over time. The Qs are up a lot more than the SPY or the S&P 500 in the bull market. And as likewise on the downside, I expect if we are in a new bear market, there'll be more meat to be made, higher profits to be made shorting the Qs than would be shorting the S&P 500, which has a lot of dividend-paying stocks, which tend to hold up in a bear market. Has a lot of energy stocks which have already had the snot beat out of them. So there's a little more value, utilities, things like that. So again, you get a little more bang for your buck, but you have to be on the right side of the trade if you're shorting the Qs. Okay, this has been Randy Finney with the right side of the chart. And as I said, I'll follow up with some static charts tomorrow and try to hone in some near-term targets. But let's see what happens. I wouldn't dive in head first. Let's see how things open up tomorrow, and hopefully we'll get a good entry. And I'll try to get some individual trade ideas going on the side as well, in addition to the general broad market ETFs. Okay.